Imagine handing your entire portfolio over to the son of a former US president, locking in a guaranteed 10% monthly return from a so-called Wall Street math prodigy. Sounds like the ultimate insider trade, right? But behind those gold-trimmed curtains of high society was a terrifying, multi-million-dollar hallucination, a total liquidity trap just waiting to snap shut on America's elite.
We're talking about Ferdinand Ward and his completely fictitious government contracts. Wall Street crowned him the young Napoleon of finance, and by teaming up with Ulysses S. Grant Jr., he built this aura of absolute, untouchable security. Smart money literally couldn't throw their capital at him fast enough to grab those massive 2 to 10% monthly yields. But there were no contracts. The whole thing was a massive Ponzi scheme built on aggressive rehypothecation. They were taking the exact same collateral and pledging it over and over again to different banks. It was the pure, distilled financial intoxication of the early 1880s. Now, you have to look at the macro environment to understand how a scheme like this even breathes. We were in the middle of this explosive, speculation-driven bull market. Foreign heavyweights, specifically British and continental banking houses, were aggressively recycling European profits straight into American infrastructure. This flood of overseas liquidity pushed railroad stock volume to a staggering 85% of the entire New York Stock Exchange. The floor was completely hypnotized by this infinite influx of cash, utterly convinced that modern industrial capitalism had permanently solved the business cycle. But here is the massive contradiction. While the tape painted a picture of endless growth, the reality was a terrifying skyscraper of debt. This massive physical expansion was built almost entirely on over-leveraged credit. We had railroad systems being constructed miles and miles ahead of actual consumer or industrial demand, pushing through vast empty deserts. You've got high fixed costs, brutal rate wars, and persistent deflation severely crushing corporate margins. The default risk was ticking constantly in the background, but everyone was just trying to keep dancing until the music finally stopped. And while retail money was blindly buying into that railroad dream, the corporate raiders were playing a much, much dirtier game. Enter Jay Gould. Gould didn't just want market share, he wanted an absolute monopoly over commercial intelligence. So he targeted Western Union, the nation's telecommunications giant. But instead of a traditional leveraged buyout, Gould engineered physical market executions. Because telegraph wires ran alongside railroad tracks, Gould, who controlled the Union Pacific, literally ordered his construction crews to chop down Western Union's telegraph poles. He physically severed the wires to blind the eastern money centers and throw the national communications grid into total chaos. Gould didn't even build his competing entity, the American Union Telegraph Company, to be a profitable business. It was strictly a parasitic corporate weapon. He laid down parallel routes specifically to ignite a ruinous price war, slashing rates to practically zero. He deliberately ate massive operating losses for the sole purpose of tanking Western Union's quarterly earnings right on the floor of the NYSE. He wanted to force panicked shareholders into a massive liquidation event. It proved that in this market, legacy wealth was only safe until a bigger, more ruthless predator decided they wanted it. Ultimately, Western Union was forced into a hostile merger, crowning Gould the undisputed king of the wires. That underlying market rot, this whole culture of fictitious wealth and violent corporate raiding, finally exploded into reality in May 1884. The music stopped for Ferdinand Ward, and when that illusion shattered, the numbers were just jaw-dropping. Audits revealed the firm held practically zero actual capital. We are talking just over $67,000 in real assets against an absolutely staggering $16 million in liabilities. The former president was financially ruined, and the broader market was suddenly staring down a massive falling knife.
This wasn't an isolated event. It instantly triggered a violent, systemic contagion across the tape. On May 6th, Grant and Ward's primary lender was forced into liquidation. Exactly 1 week later, the Second National Bank suspended operations when they realized their president had embezzled over $3 million and skipped town to Canada. By the very next morning, terrified crowds were swarming the Metropolitan National Bank. Because Metropolitan was a core reserve agent for regional banks all over the Northeast, this sudden run threatened to completely freeze the national payment system. Counterparty trust just evaporated overnight.
And this is exactly where Wall Street hubris slams straight into Main Street reality. It wasn't just institutional operators taking a massive haircut here. The impact on the retail investor was catastrophic. Everyday depositors across New Jersey and Pennsylvania woke up to find their life savings locked up because their local community banks relied on those frozen Manhattan reserves. Retail savers who bought the top of the railroad boom watched their certificates instantly turn into worthless wallpaper. Because that same collateral had been pledged 5 or 6 times over, everyday people realized they didn't actually own a thing. to halt a total systemic wipeout, the New York Clearinghouse had to step in as the absolute lender of last resort. Between May 15th and June 6th, they had to literally invent $24.9 million in emergency interbank loan certificates. Why? Because the Manhattan banking system had straight up run out of physical currency. These certificates were issued at a steep haircut with a 6% interest rate, and they were the only thing keeping the interbank payment clearing system breathing. It was an unprecedented, desperate patch on a massive bleeding artery. Following this near-death experience, the Wall Street floor mutated into a psychological war zone. On one side, you had aggressive bulls doubling down. They were betting on unprecedented industrial efficiency, believing that massive horizontal consolidation was the only way to generate truly stable wealth. On the exact opposite side, you had skeptical bears screaming that this whole setup was still a corrupt, over-leveraged house of cards. The bears were betting heavily that all this extreme corporate fraud and public outrage was going to inevitably trigger an explosive regulatory crackdown. So, to survive, the bulls realized they had to completely adapt their game. To weather this economic hangover and put an end to the cutthroat price wars, industrial captains just abandoned the open, competitive market entirely. They deployed a ruthless, revolutionary new legal weapon engineered by Standard Oil's attorney Samuel Dodd. It was called the trust. By pooling separate corporate securities under a single board of trustees, these massive companies could eliminate competition, fix prices, and legally swear under oath that they didn't operate outside state lines. And this legal loophole spread like wildfire. By 1882, Standard Oil controlled 90% of refined petroleum. You had cotton oil, linseed oil, the sugar trust. These massive monopolies were swallowing the entire American economy. But here's the real kicker for retail investors. They operated in total, absolute corporate secrecy. They refused to publish financial reports. They wouldn't release balance sheets. Since they couldn't meet standard listing requirements, the NYSE actually set up an unlisted department. These massive trusts traded as completely blind gambling pools, where insiders could float false rumors, manipulate prices at will, and legally extract hundreds of millions of dollars from an unsuspecting public. Eventually, public outrage hit a boiling point. The bears thought they had finally won when Congress passed the Interstate Commerce Act in 1887 to kill the rampant price gouging and secret corporate rebates. But smart money moves incredibly fast. When federal oversight loomed, Wall Street simply rotated its capital. Seeking a massive tax revenue bump, New Jersey radically liberalized its corporate laws in 1888, explicitly legalizing holding companies. Just like that, operators converted their legal trusts into perfectly legal corporate mergers. They permanently outmaneuvered federal oversight, keeping the wealth extraction engine running at full speed. If there is one enduring lesson to pull from this Gilded Age capital boom, it's this. On Wall Street, the absolute most dangerous time to deploy capital is precisely when the returns look the most golden. When the macroeconomic narrative feels flawless, when foreign capital seems endless, and when you're being pitched risk-free double-digit returns, you are almost certainly standing at ground zero of a massive liquidity trap. The absolute brightest speculative euphoria is almost always funding the darkest systemic fraud. Which brings us to a really critical realization about the market we're trading in today. Take a hard look at your own portfolio right now. Look at the massive consolidation of market cap into just a handful of dominant tech giants that operate with unparalleled control over commercial intelligence and modern infrastructure. You have to ask yourself, are the hidden gears of market consolidation, regulatory evasion, and capital extraction that we just saw in the Gilded Age driving those exact same systemic risks today? Are today's tech monopolies just the 1880s trusts operating in disguise? Drop your market outlook and let me know your thesis in the comments below.
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.